Hello, everyone. Today on the Final Bar, it's Monday, October 3rd. We'll look at this market ripping to the upside, bouncing off of that 3,600 level. What does this tell us about the overall conditions in the short term related to the long term? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. Technical analysis is designed to help us understand what is happening in the markets by focusing on the evidence the markets provide back to us, looking at measures of price and breadth and sentiment. We'll try to get to as many of those charts as we can in 30 short minutes together. Did want to let you know what's coming up here schedule-wise. Kind of a unique week. We will be doing a show today and tomorrow, running it a little bit later than normal at 6 o'clock Eastern. After that, we will be fully 100% focused on ChartCon. ChartCon 2022 is happening this Friday and Saturday, October 7th and 8th. You can go to stockcharts.com/ChartCon to sign up for this event. We have so much great content that we were working on over the two-day stretch. It's going to be a ton of fun. Today, I wanted to highlight Julius de Kempener. Julius actually just arrived in our Redmond offices today from Amsterdam. He's the first of our commentators coming in from out of town and joining us to put on ChartCon from our new studios in Redmond. He will be doing an intro to sector rotation, where he'll be talking about how to think about sector rotation, obviously using his RRG methodology and talking about sector themes in different parts of the cycle. Then he will also be a participant in our bull versus bear debate. He'll be taking one side of one of the asset classes we throw at the team of 8 strategists, and we'll have them debate bull and bear characteristics of those charts. You can sign up for that event for free at stockcharts.com/ChartCon. Also, we'll be doing a market outlook panel where we'll be featuring results in a survey on that website. There's a link to take the survey, so I'd love if you could do that before the event as well. All right, let's continue on today's show and talk about the markets here. The S&P, the NASDAQ pushing to the upside, pretty impressive run, moving onward and ever upward. That's actually not a great way to describe this market. It's been downward. It's been lower and ever downward, I guess, for much of 2022. But today, you're certainly getting a reaction, I would argue, to the breakdown below 3,600 on Friday. Friday was key. We made a new closing low for the year. The S&P closed below 3,600. That's all pretty important. And both the S&P and the NASDAQ by the end of last week had undercut their lows from June on a closing basis. I think that is important. So today you get a nice mean reversion bounce to the upside. Everything that has been down moved higher. Things like the S&P up 2.6%, just below 3,680. Almost made it to 3,700. Didn't quite get there. The NASDAQ composite around 10,815. Mid caps and small caps both up as well, with mid caps the best performer. The VIX pulling back a little bit, had been in sort of the lower 30s, back almost to 30, didn't quite get there. That VIX over 30 has been important because that's where the VIX has been when the S&P has bottomed out previously in 2022, something certainly to keep an eye on. We'll continue on. Just as a reminder, on Monday, what we like to do is start big picture. We'll look at the major averages, the major asset classes, how they're rotating. Then we'll get into sectors. And then after the break, we'll get into shifting stocks. And we'll talk about some of the individual names, how they relate. Again, the whole goal of this is to mirror in some small way my normal process of starting macro and going to micro. And I like to hit some of the highlights on the show here every Monday. Interest rates coming off a bit. So if you wonder how the market was up, the market has been down overall in the course of 2021 due to a couple things. I mean, I would argue almost entirely due to the Fed and what they were trying to do. But the actions and the game plan of the Fed, I think, has been most reflected in higher interest rates and a stronger dollar. If you look at what happened today, the dollar came off. UUP was down about 0.5%. 10-year yields came down to around 365. That's after finishing last week around 380. So rates come down, the dollar weakens out a little bit. That gives space for risk assets to bounce to the upside. Gold having a decent day, and there's not many days in 2022 I feel like I've been able to actually say that. We'll see how that plays out through the course of this week, because it's been a tough year for gold and silver. But gold up just over 2%. The silver ETF SLV up over 9%. Commodities as a whole doing very, very well. I had some oil-related news over the weekend, and energy stocks are doing well. We'll get to that a little later in our segment on sector rotation. Finally, cryptocurrencies, a lot of green here, and over the weekend you saw them rotating lower, particularly yesterday on Sunday Eastern, as you saw, Bitcoin just sort of and Ethereum sort of having this nice consistent downtrend, rotating back to the upside, bouncing off of 19,000 for Bitcoin, not getting to 20,000, but getting closer, and it's sort of seeing that. And I sort of made it clear to everyone when Bitcoin gets above 20,000, I think we can start to take it seriously. It did briefly happen over the weekend, but didn't, sort of repelled that advance. That's the sign of a chart I'm not interested in. It gets above 20 and stays there. That's where we will start talking about things in a little more detail. Let's look at the S&P chart and just see where things are at. So again, it's, people often ask about particular levels, and I try to, when I answer them, I keep them very general. So if you watch the show, if you follow my work, I tend to stick to broad levels like 4,000, 3,800, 4,600. And I do that because I am firmly convinced, after doing this for 20 some years, that in the age of decimalization and dark pools and electronic trading, the idea that a price would hit a particular point to the penny and then reverse, and that has some meaning, I think that is literally meaningless. What I've learned is that you need to think in support and resistance ranges, I've thought about that for quite some time. Arthur Hill, I spent some time working with him on how he was using the StockCharts platform to illustrate support and resistance. He uses these shaded areas, which I had sort of gravitated to. So, hats to him for the suggestion. It's a great way of sort of illustrating what I think is a reality, which is, back when stocks traded on an eighth, you could assume that something hit a certain point and that had meaning. I think in the age of decimalization and again, all the other factors that I mentioned, structurally, that's not a reasonable expectation that when things are trading at sub pennies, that you would hit a particular point. So I tend to keep things a little more general. I tend to just think in generalities and focus there. So, the low from June, 36.35 or so, you can see we've broke below that about a week ago. We finally closed below that level for the first time on Friday. Today, we're bouncing back to the upside. So I would, given the bounce today, I think you're still seeing this, general test of an attempt to make a new low. It's coming out of the oversold region, which we saw, beginning of last week. Just sort of bouncing off of there today. So, could you see a brief mean reversion bounce? Absolutely, and especially coming off of testing a key support level like the June low, I think that's meaningful. A lot of individual stocks we'll talk about is Expedia, and we've highlighted others like Home Depot and others all sort of testing support. I think that's a big part of the rest of this year is stocks like that and the major averages as well, testing support and whether those levels can hold. A bull market environment has stocks testing resistance and breaking out. A bear market environment has things testing support and then breaking down. I think that's what we've seen so far. Look at some communication services stocks if you want examples of that. Now we're at where almost the bulk of the markets and certainly the major averages are now testing their June lows. If these levels hold, nice mean reversion bounce to the upside and potentially could be the beginning of something more significant. Given the break on Friday, I am very much in the bearish camp. Today is a nice bounce off of a new low, but I don't see it as anything more than that. I'd have to see more to be convinced of anything more significant other than a bounce off of the key support level. So at this point, certainly I think the path of least resistance appears lower for stocks. And again, even with the rally that you saw overall today. Just to finish off our segment here on the big picture. Actually, no, let's go right to sectors. I was going to say we're right at the sector point. Let's go there. So the second part of our three-part approach on Monday is to start with the big picture, which we've done, and then go into sectors and think about the rotation of these different things. Just to check in on what happened today, you had energy up in a big way, up 5.6%, far outpacing the rest of the market. But another number of other sectors all up almost 3% plus. Materials, tech, industrials, just barely utilities, all 3% plus or so, which is pretty impressive. What sectors dragged the performance down? One notable outlier, consumer discretionary, the XLY, which was flat. Now, Tesla, which is one of the biggest stocks in the XLY on a market cap basis, down 9%, is certainly going to cause the XLY to not sort of line up with the rest of it. If you look at the XLY, except for Tesla, it's probably a much better return for today, but it, of course, does involve Tesla as one of the key. About a quarter of the ETF is probably Tesla at this point. So down 10%, 9% that is, certainly will hurt that. Consumer staples and REITs were after that. Healthcare is one of those interesting stocks, interesting sectors. We'll hit on a stock or two in that sector a little later when we get to shifting stocks. But let's look through the 11 S&P sectors using the RRG. And again, I mentioned Julius de Kempener just arriving. We're super excited for ChartCon coming up this week. The reason why we're doing the show a little bit later today and tomorrow is just to give the StockCharts TV team all the focus that they have available on ChartCon. We want to make that event really, really awesome. So Julius just came in. So in celebration of his arrival in the Seattle area, I want to start with the RRG and hit on sector rotation. Such a beautiful way, simple way of just illustrating the fact that many of us have experienced through multiple cycles, the fact that sectors just naturally rotate around the benchmark. This is what a lot of active managers try to capture, try to find ways to capture that rotation and different ways of trying to make that bet. Things that stand out on the weekly RRG, which is what we're looking at here. Number one, look at how utilities, the farthest to the right. So it's in the weakening quadrant, which is down here, but it's sort of rotated back up this way. If we rewind a little bit, now let me zoom out just a touch. If we rewind back to, going into the August peak, you can see utilities had been strong, kind of rotating southwest. And then in the last 6 weeks, look at how it's rotated so nicely up to the upside. You can also see the same thing with energy, which is way down here. Look at how that's ripped back to the upside. Consumer discretionary, which had been so promising, now rotating down to the southwest direction. And again, part of that Tesla, of course, but it's not just Tesla, right? It's other stocks that make up the XOI as well. So only 4 sectors in the leading quadrant: energy, industrials, financials, actually getting back to the leading quadrant, which is worth noting. And ones that are improving, that is rotating recently into a positive direction: energy, utilities, consumer staples, and healthcare. And utilities and healthcare, along with energy, are two of the areas that I would certainly like to highlight. In this environment, when it feels like everything's struggling, when it feels like everything is having trouble, the most important thing you can do is focus on relative strength. I would argue relative strength is always something that should be a part of your process, but especially in this kind of environment, it feels like everything's struggling. Look to areas of the market that are performing better than the averages, and that's where you look at the relative strength line improving, the RRG, things heading northeast, ideally going into the leading quadrant. That's when you really see renewed relative strength. Let's look at the 11 S&P sectors now using the candle glance function. I love this function on StockCharts. I've shared this story many times, but in my Fidelity days, we used a ton of paper, which I don't feel great about, but it was what you did at the time. And we would take a bunch of paper charts, print them out, and then lay them on a table. And it would be a common sight if I would glance into some of my analyst rooms that they would just have their desk full of paper charts and just be putting things in piles: the good pile, the bad pile, and the maybe pile. And then after you did that, you'd sort through the good pile and find the really good to the kind of good. And then you go through the okay pile to the okay leaning positive, okay leaning negative. And that was how you'd start to differentiate any group of charts, any group of stocks into particular buckets. That's what the candle glance function really allows you to do, is to try to identify what looks like what else, right? And not just look for similarities, but even more importantly, look for outliers. So when I'm looking at this, general things you can do is take a step back, literally take a step back, lean back from your monitor, and what kind of patterns do you see? Well, I can't help but notice that at this point, almost all of the 11 S&P sectors, as well as the S&P, save one, are below 2 downward sloping moving averages. In most of these, they are below the 50 and below the 200-day, both moving averages sloping lower. That's not great. The only one that bucks that trend is the XLE, the energy sector, which is actually above the 200-day, testing the 50-day moving average from below today. What else looks different? Well, energy is certainly an outlier by any stretch, right? And if you look at the XLE, you have this sort of coil pattern of lower highs and higher lows over the last 4 months, sort of that all-time high or that new high in June, and making a lower high in August, sort of coming in, consolidating the range. The rest of these are really more negative, either testing new lows for the year or attempting to make a new low above there, but it's certainly down in that lower end of the range for 2022. So what looks different? Energy certainly stands out as an outlier. I think that's very much true. What else can you note? And other things that you can do to relate the charts. Well, some of these are making new lows in September into early October, particularly communication services made a new low in September, as did consumer staples, as did materials, industrials, technology, real estate. All of those have made a new low in September into October, including the S&P as well. Obviously undercut its June low. We talked about that earlier in today's show, and certainly in recent weeks. So the rest of these have actually made, for now, a higher low or are testing support. Let's look at those in a little more detail. So which ones are well above their June low? Well, energy we've already covered, but that certainly is part of it. Healthcare, right, above the June low. Discretionary, above the June low. Financials really still testing, right? It's sort of not quite breaking down, but not really above. It's sort of in that no man's land. Utilities certainly with a higher low, and that's about it. So if you're generally looking at a group of things, in this case, we're looking at a group of 11 sectors in the S&P. One of the great ways when a market is moving lower is how many of these are making new lows or have already made new lows. Which of these have not made new lows yet? And if you're looking for places to focus, I would tend to focus my attention on the sectors that have not yet made a new low, because that means most likely on a relative basis, they're outperforming. That means selling pressure that is dominating some of these other sectors, like communication services, not as magnified in those sectors. And that could potentially be a place to ride out this sort of deterioration. So as a reminder, the areas where I'm seeing those higher lows so far, consumer discretionary, potentially financial, certainly healthcare, and the only other one, utilities. Those might be some opportunities to focus on from a sector perspective. Let's take a quick commercial break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close for our show. Thanks for being patient with us as we adjust the schedule a little bit because of ChartCon. A lot of our programming will be taking a break this week. We'll be back live all next week for sure. A couple quick announcements before we complete today's show or continue on. First off, we welcome your questions. We're going to do a mailbag segment a little later in this week. We'll do one on tomorrow's show on Tuesday. We'd love to feature one of your questions live on the air. Our email is always open, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Just put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Tuesday's show. Also, go to StockChartsTV.com. That is our on-demand platform. Such fantastic content every trading day. I'm super proud of what the Stock Charts TV team has done to make all this content available, and also our great group of contributors, always thinking of the markets, always trying to get good ideas and thought-provoking content your way. You can access all of it for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. Let's continue on our show today. Going to our next segment, Shifting Stocks. As a reminder, Monday, we go through 3 steps. Macro, big picture, talk about the bounce today, but overall the weakness, I think, is still prevalent in the equity markets and other risk assets. Talk about sectors, some of those areas of the market that we highlighted on the candle glance page, really showing some potential strength. Let's talk about some individual names sort of on the move and things we need to be aware of. We have to start with Tesla, and we have to do it because big name, obviously a mega cap name, and one of the larger names in the consumer discretionary sector, certainly showing some renewed weakness today. Gap lower, and again, news-driven gap. But again, when I'm asked about news and what that means relative to the chart, in a lot of ways, like I want to be a well-informed investor, and in my own investment process, if and when I buy individual stocks, which I honestly don't do a lot because I found my attention is best spent elsewhere. But if I do, I would certainly do the due diligence to understand the company and the prospects for that name and how it relates to the chart. On this channel and in our show and in most of our work, we really focus purely on the technical inputs because I feel like that's where a lot of investors are under aware, right? They need more focus and need the discipline that charts can provide. So having said that, let's talk less about what caused this move and more about what the move means to the chart. The story of Tesla certainly is a bottom in May before the markets bottomed in June. So it actually bottomed a little earlier than the rest of the markets. Well, a lot of things were, sort of in a consistent downtrend in the first 6 months of the year. Tesla was a bit of an outlier, almost like an Apple chart, rallying up, just like Apple, tested all-time highs in August. Tesla was actually testing its high in April, right? So a lot of stocks were well below their November, their January high. Tesla was kind of right back up there. Made a new low in May, higher lows in June and July, and then rotated back up to the 200-day, and that's where things stalled out. Look around that 310, 315 level. That's where we hit resistance in August. Once again in September, just a really consistent resistance level. Tesla has not been able to break that. We then got to the lower end on Friday, closing below the low from early September. Today kind of gaps down and pushes to the downside. What that means from a technical perspective, I would argue, we've now broken support. We failed at resistance. We've broken support. The trend by definition now down, and you look to potential downside support. I'm looking at the 210, 220 range. Those are the lows from May, June, July. If we fail to hold support, fail to hold moving averages, that's where I'm looking for potential support levels going forward. Relative RSI, by the way, very close to being oversold. Last time it was oversold was back here in May. That ended up being so far the low for the year. But again, feeling a little heavier. So it's interesting. While stocks were rallying today in general, most stocks were up today. Charts like Tesla actually deteriorating and pushing more to the downside. Other charts to highlight, we've highlighted like Home Depot before, and Home Depot is, I think, a great example of many stocks that have this similar look. Made a low in June, tested the 200-day in August, now back and once again testing the lows. Home Depot has actually bounced very nicely off of there. Had a pretty decent week, closed down on Friday, but overall off the 265 level, which is where we had bottomed out in September, continued to push higher today. So, again, is it a potential double bottom? Absolutely. Would I want to take a position in this name? Again, never making any formal recommendation to any of you, but I'm not a big fan of taking on risk of any sort at this point because of my general trend following approach to, really being in capital preservation mode when the major averages are down in an established downtrend, as I feel that they are. However, could you take a position and could you use the lows in September as a natural stop to that? I could get the technical argument. If you see upside back to, even the 200-day moving average and downside to the previous support level around 265, that's not a bad risk reward. It's not the best that I've ever seen, but not bad in this environment. Here's the problem on a chart of Home Depot, though, is we break below 265, then what? Now we're in, pun intended, uncharted territory. That's where Expedia and others come into play as well. There are a lot of names that made a low in June and July or July, bounced higher, and now retesting those levels. A lot of those, like Home Depot and like Expedia as well, have shown a nice bounce off of support. And what that represents, I think, from a behavioral perspective, are a bunch of investors that saw the price come back down to where it was, clearly bought before. They buy in and provide the support many of us would expect. So anyone that bought in the last week and a half is basically in the green right now. Here's the problem, though. What happens if this rally that we saw today fizzles out? What happens if charts like Home Depot and Expedia break support? This is when a waterfall decline can start to happen. And here's why. Again, behaviorally, a bunch of people have bought maybe starting in July and did very well. You had a bunch of people, obviously, that bought in the last week, all feeling very smart and very good about themselves. What happens if all of them go from being in the positive to being underwater, and everyone that bought at 90 is all of a sudden sitting on a paper loss, seeing other risk assets break down? They start to panic and they sell. That's what causes additional push to the downside. That causes more people to get triggered and to sell, and that's what causes things to spiral downward very quickly. So I think Expedia is a key name to watch, because it's bounced off support so far, which is encouraging. However, if we break that support, I think that's when things can get very ugly very quickly. Vail is another one, similar one I was asked about. And, one of the questions I got in the last week, if the markets are so bad, if all these conditions are so bad, how could Vail, right, just sort of like a travel tourism, kind of name, be bouncing so much, right? If conditions are so bad, how can things be bouncing that much? You have to remember the relationship of these timeframes. Something bouncing over a week really doesn't connect a lot to the longer term trend necessarily, right? And you can see that by the fact that Vail overall has been in a downtrend. You've seen a number of counter trend moves where even though the larger trend has been down, charts just don't go straight up or straight down. They go down and they sort of fluctuate wave-like, which is what Elliott and others, Gann, really talked about, the wave structure of cyclicality, particularly in the short term. That's that swing trading time frame. So remember that a short-term bounce off of a new low makes sense. That's just a tactical reality of stocks. Anytime something breaks, you'll see people that sort of buy in on a quick bounce higher. They can just as quickly sell those short-term positions. That again provides the move back to the downside. So I don't think you can make any sort of assessments on the economy based on something like Vail bouncing up over a couple days to even a couple weeks. That's more telling you that the market is naturally reverting back to the mean after some significant downside pressure through the course of this year. We only have about 30 seconds left here. Geez, this goes quickly. So Goldman Sachs. General Mills. Just want to finish off highlighting energy as an area certainly we could talk about. We highlighted DVN and others, impressive bounce higher in the energy stocks. But I want to highlight consumer staples. Again, it's one of those sectors that has not made a new low yet for 2022. And charts like GIS, not all of them look this great, but look at the relative strength over the last year. Not a bad chart to own, right? With all of this going on, who would have thought last September, if I sat on, General Mills, a cereal company, an oatmeal, for the last 12 months, that I do pretty well, and it's certainly showing you that's the case. Look how the RSI is just consistently in the bullish range. This is a strong chart among other strong charts, and my point is to focus on relative strength. That's going to get you in the names that are weathering this environment well in any case. We need to wrap the show. Go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. In our macro segment, we're going to get too deep into the non-equity charts, but I just wanted to highlight the dollar coming off a bit, certainly giving some room for risk assets to bounce today. This chart is just simply looking at the US dollar index, crude oil future, and the gold future, right? And looking at the 3 of these together. The reality is, if you think about the general moves in 2022, strong dollar environment has certainly been one of the key factors, and what I think it means, what it represents, is what has been so difficult for risk assets. But when I get people saying, well, if the dollar's strong, commodities should be weak, the answer is maybe, right? And you can look just on this chart. Look in 2021, strong dollar, strong oil, strong gold. That happens sometimes, right? There are times when gold and crude oil and the dollar all kind of move together. There are times when the dollar's moving higher and crude oil is moving higher and gold is coming down. There are times, like much of the last 6 months, when you see stronger dollar, weaker oil, weaker gold. So I would caution you from making simple relationships and drawing conclusions. These relationships are fluid over time. However, the general playbook that I'm sort of looking at starts with the stronger dollar. And as long as the dollar keeps going higher, really tells you that rates are higher and inflation is a problem. And until that changes, tough to see a lot of change in the broader equity trends. Chart number 2 is Tesla. In our segment Shifting Stocks, we talked about Tesla and what that chart means. Again, the breakdown of support is concerning to me. This is a key name in a key sector. The XLY flat, while most sectors were up today. Tesla's struggling, and I could see further downside, maybe a retest of the summer lows for a key stock. Finally, United Health Group. We talked about in our segment Shifting Stocks about some of the names I think showing strength. UNH is one of those that is interesting to me. DVN and other energy names pull back to their 200-day rotated higher. Very curious if UNH will be able to pull off the same trick. But again, look at the relative strength over the last year. Hey, folks, that's a wrap for this show. Thanks so much for joining us every weekday after the close for the final bar. As a reminder, all of our previous episodes and interviews are at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.